So if you're a dividend investor, you know that it's not that hard to find dividend stocks that have enough yield and have a great dividend growth rate and are safe. But the big conundrum is finding quality dividend stocks, ones that you never have to worry about because they only yield 1, maybe 2%. And the truth of the matter is you're just never going to reach your goals anytime soon with dividend yields that low. But what if I told you that there was a very simple way to take these dividend stocks, these quality dividend stocks, invest in them, and just like that, increase their dividend yield from 1 or 2% to 7, 8, 9, 14, even as high as 19%. This is not clickbait. I'm not blowing smoke here. I'm doing this right now. Let me show you. Now, I'm sure you notice here, this is not my normal backdrop. My wife and I are actually in St. Louis right now. We're using this opportunity right now to actually explore other parts of the country as potential landing spots where we might move after we leave California for our 12-month trip around the country. So in this video, guys, I'm going to share with you 10 different real-life examples right now, today, dividend stocks. 7 of them are dividend champions, meaning they've raised their dividend now for at least 25 consecutive years. And 4 of them have raised their dividend over 50 years now. Here's the list right here. We're going to look at Altria Group, Walgreens Boots Alliance, Kimberly-Clark Corporation, Coca-Cola, PepsiCo, Aflac, Allstate, Comcast, McDonald's, and Oracle. As you can see, a few of these have lower dividend streaks here, 12 years for Allstate, 14 years for Comcast, and 13 years for Oracle. But otherwise, we're looking at really long-standing dividend growth rates, 52, 47, 50, 60 for Coca-Cola, 50 for Pepsi, 40 for Aflac, and 47 for McDonald's. And their dividend yields, for the most part, are relatively low. Now, we've got a few higher yielder ones here, Altria, Walgreens, and Kimberly-Clark, but otherwise, everything is below 3%. 2.76, 2.48, as low as 1.58%. The great news is we can take every single one of these dividend stocks and we can, just like that, make them a high-yield dividend stock. Some of them ultra high. So the strategy we're going to use here for these dividend stocks is a covered call strategy. Now, to be very clear here, what is a covered call strategy? Covered call strategy is where you utilize existing stocks that are in your portfolio. You already own them, you're not adding new stocks. And then with the dividend stock you already own, you sell, also known as write, call options on that dividend stock. When you sell a call option, you are making a commitment as the seller to sell 100 shares of the underlying dividend stock to the buyer if the price of the dividend stock is at or above the strike price of the option that you sold. Let's say you own a dividend stock and the current price per share is $150 and you sell a call option at $160 per share, which is the strike price. And let's say it's a 30-day option. If the price of the dividend stock is below $160 by the time the option expires, then nothing happens. You keep all of the option premium that you received for selling the call option and you keep the shares of your stock. Now, if for some reason the price is above the strike price, whether it's 161 cents or as high as $170 per share, then you are committed to selling 100 shares of that dividend stock to the buyer. But that's not a big deal because you already own 100 shares of that dividend stock. So your own shares are then sold at that strike price to the buyer. And when this happens, you still get to keep your option premium that you received for selling the call option, and you still are locking in a gain on the stock because you owned it at $150 per share and you're selling for $160 a share, which is a $10 gain per share of the stock that you own. The only risk here is opportunity risk. In this example, if the stock were to shoot much higher, let's say $175 per share for whatever reason, and you had to sell it at $160 per share, you would not get to participate in the extra $15 per share. But like I said, you're still making a gain on the stock because you had it at $150 and you sold it at $160. So you just lose out on the additional opportunity above and beyond $160 per share, but you are not losing money. Now let's dive into this strategy and show you real life opportunities and examples. In this scenario, I'm looking at options that are going to expire 30 days away from today, a 30-day call option. And I'm looking at options that I can sell with a delta of 25 or less. Essentially, when I talk about the delta, I'm talking about the likelihood that a dividend stock will be in the money or above that strike price after 30 days. So when I say a 25 delta, I'm talking about a 25% likelihood that your shares will be called away from you. Okay, so we're looking at Altria Group here. Current price per share is $54.75 per share. right up here. Here's our strike prices, meaning that is the price at which you would have to sell your shares if the price is above that amount at the time of expiration. This is the bid and the ask. The bid price right here is the highest price that somebody is willing to buy the option, and the ask is the lowest price that somebody is willing to sell the option. These are quoted as per share. So you would take this number and multiply by 100 to get the actual premium you would pay or you would actually receive. So in this case, right now, 55 would be right at the money, right here. And we would look at a delta, right here, here's our deltas right here. We would look at a delta of 25 ideally. So we'll look at 23 right here, 0.2371. So this is a 23.71% likelihood that an option is going to be in the money at the time of expiration. Here is our bid and our ask price, 46 and 60. For the purposes of this example, I'm going to be super conservative. I'm not going to take the ask price. I'm not going to take the middle between the bid and the ask. To be super conservative, I'm going to take the bid, which is usually lower than you're going to get. Usually you'll find something between the bid and the ask as a way to just take an average. I'm going to take the bid to be super conservative. So instead of taking 60 cents per share, I'm going to take 46 cents per share right here. So 46 cents times 100 would be $46 you would receive for that option. And then to calculate the overall yield for a dividend stock, I'm going to take their current yield based on their annual dividend per share. And then I'm going to add in an assumption that I can get this amount right here, 46 cents per share times 100, and that's per month. I'm going to take that times 12. We're going to first look at Oracle Corporation. Right now, their dividend yield is 1.58%, and their annual dividend is $1.28 per share. I've got all of the underlying screenshots just to show you that I'm not blowing smoke. I'm actually looking at actual data. And by the way, if you want to get an opportunity to look at this spreadsheet and you want access to it, it's in the Patreon community. If you want to check out being a part of the Average Joe Patreon community and the private Discord channel where you can talk to me, talk to other people who are dividend investors, it's a great opportunity to learn from others and just get ideas from what other people are doing with their strategies. If you're interested in that, check out the link down in the description below. All right, here's Oracle Corporation right here. We looked at this delta right here. Price was currently right around $76, $77 per share. We were looking at an $81 strike price, which was a 25 delta. And for that, we would receive $84. 84 cents right here per share times 100 is $84. When you factor this in for Oracle, you would get $10 per share over a year, and that would take the yield from 1.58% to 14.04%. If that's not high yield, I don't know what is. This makes Oracle look like a much more attractive dividend stock when you can get this much more yield and much more cash flow out of the stock every year. All right, next up here is McDonald's Corporation. 47 years of consecutive dividend payments, currently yielding only 2.2%. Got an annual dividend of $5.52 per share. We used a 28 delta right here at a 260 strike price. We'd receive $129 per call option, and then you would receive that 12 times a year. That gets you an extra $12.24 per share over the entire year, taking your yield from 2.2% up to 7.06%. which automatically makes McDonald's a high yield dividend stock. Next up, let's take a look at Comcast. Comcast, 14 years of consecutive dividend payments. Look at these dividend growth rates, really great. 44, 9, 12, and 16 over the 1, 3, 5, and 10 year growth rates. We've got only a current yield though of 2.28% and an annual dividend of $1.08 per share. We're looking at a $49 strike price, which is a 21 delta, which would conservatively net you $38 per share once a month times 12. When you add this up, it would be $4.56 per share annually, which would take your yield from 2.28% to 11.89%. Now, I'm not gonna sit here and take this video and make it 20 minutes long just because I can. So I'm just gonna go ahead and review the rest of the dividend stocks for you and just show you how these dividend yields can transform from as low as 1 or 2% to much, much higher. So here's Allstate. Goes from 2.4% under this strategy to 10% annual dividend yield. Aflac from 2.44 to 12.52%. These are Dividend Champions now, by the way. Pepsi from 2.48% to 11.84%. Coca-Cola 2.76 to 11.59%. Kimberly-Clark, this one actually was prudently conservative here. It goes from 3.68% to 9.87%. Didn't have great option chain metrics, but I included it just because it's a 50-year consecutive dividend champion. Walgreens Boots Alliance, one that I'm actively doing right now. And same with Altria. I'm going from 4.21% annual yield to 17.94%. And then we've got Altria Group going from 6.65% to 15.52%. And by the way, guys, if your shares end up getting called away from you, your gains on these stocks are even higher than this, the actual returns from the stock. And if your shares get called away from you, then just go out and buy them again and do this all over again. The stock price might be a little bit higher than you paid for it, but you can always use a little bit of extra money to make sure you can get back into whatever the current market price is and start the process all over again. And with all this option premium, you can do whatever you want to. You can just take this money out if you want to and use it for other reasons if you're at the point where you're actually living off of your dividends, or what you can do is take this money and then invest it back into these dividend stocks or other high yield dividend stocks. I guess the point that I'm trying to say here is, why would you just sit there and hold these quality dividend stocks and just accept a dividend yield of 1 to 2%? You don't need to do that. You can guarantee yourself a much higher dividend yield on a high quality, really high quality dividend stock here, and you can still have a big buffer between your strike price and whatever the current market price is, so the likelihood of your stock being called away from you is really low. Let me show you my strategy right now in my own portfolio so you can know that I'm not just talking the talk here, I'm actually walking the walk as well. So I've got Aflac right here. I own that at $66 per share. I've got a call option right here at a $69 strike price. Call option, I received $54 for that option. That expires on May 20th. Down here, I've got Colgate-Palmolive, same idea here. Here's Comcast, I showed you that one. I've also got this with Gilead right here. I've got it going with Intel. I have it with Starbucks. I have it with a dividend ETF actually with Schwab. I've got it with Verizon right now, Walgreen Boots Alliance, and I'm also doing it right here with ExxonMobil Corporation. This is something you really seriously need to consider doing, especially if you're doing this in a retirement account, because all this option premium is not going to be taxed. Even if you're doing this in a taxable account like I am, the benefit that you get from this is so much higher than the cost or the negative of having taxable consequences. Make sure to leave your 2 cents down in the comments below if you have any questions about the strategy. I'm more than happy to make a follow-up video and just show you other opportunities available out there. If you like this video, guys, check out this one right over here. You can continue the conversation with talking about dividend stocks and selling call options. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.